Your host, David, America's #1 credit expert, John Ulzheimer, formerly of Equifax and FICO. John, welcome.
Hey, David, thanks for having me. Happy 13th of July.
I know. I got a birthday coming up. It's so funny. One of my friends said, "Hey, your birthday's going to be this week, right?" I'm like, "Oh yeah." Once you get over like 45, they're just not really. It's not the same thing
Yeah.
anymore. It's not like I'm not getting big presents. Nobody's baking me a big cake these days.
Yeah.
So 52 is not going to be all that exciting. All right. It feels a little funny going into it without like the 1 minute intro and then your intro that I play. And then we get warmed up a little bit. We got about 10, 15 people on with us or whatever it is. So we got some people jumping on now. Thank you for joining me and John. Feel free to post your questions. That's what we're here for, today's Q&A. So, John, I got a couple things I wanted to talk about.
Okay.
First of all, Mike is 52 on Friday. Mike, I'm going to be 52 on Saturday. All right. Well, shoot, man. We're
Children,
almost
babies.
twins, right? We're
You're
almost
babies.
twins. John, babies. You're like 2 years older or something like that.
Barely.
Maybe 3. Maybe. Okay. All right. So, John, I don't know if you saw this. This popped up, and we're not really talking about credit repair. We're talking about the industry itself. And I gotta show you this. Did you see this? The $3.3 million scheme. A woman arrested for running an illegal business claiming to fix customers' credit. This is out of it's out of Texas. I forgot where it is. So, John, early on, when I first met you, so this was I almost said Credit Con. This was Boot Camp 2013. One of the guys there told this story about this group in the Northwest who was filing false police reports because there was a police department up there where you could log on, no joke, log on and file a police report. And they were logging on, creating police reports on behalf of their clients, claiming that their identity was stolen. And they're creating these identity theft disputes with an enclosed police report, effectively removing all of their derogatory credit under the claim that it was fraud, it was identity theft. Well, anyway, those fools got themselves 3 hots in a cot, and they're now a guest of the federal penitentiary down there. And I don't know if they're still in jail, but they arrested all of those guys. All of them went to jail, and I think maybe some of the clients did too. So you hear these stories, and you're like, man, nobody's going to ever pull that one again. I mean, that is just like the dumbest thing you can do. Nope. Leave it to people in the credit repair industry. That's exactly what she did, John. Did you read that article? Have you seen that one?
I have. I didn't know if we were going to talk about it. I love talking about stuff like this because it just kind of, I don't know. The certainly filing police reports, false police reports, and false FTC fraud affidavits are, I mean, the term is unlawful, which, in regular speak means illegal.
Yeah.
The problem is that they nailed the head of, and all you have to do is Google it, and you can find a bunch of articles around this. The problem is that they're also going to be able to find out every single person who was a client of hers.
Right.
I think her last name was Brisby.
Yes.
So if you just Google credit repair Texas Brisby, you'll find it. And then they're going to find all the people who essentially filed the false police reports through so they're going to find all of this stuff. It's not, there's no secret. So
no, there's a paper trail you could trip over. It's going to be simple.
Right. And I'm not the morality police, right? People can choose to do business however they want, but if you play stupid games, you may win stupid prizes. And you and I have gone to enough of these credit related events over the past 10, 15 years that we've we've heard the woe is me stories and complaining from credit repair companies. Why do we still have this bad reputation? And why won't people consider us legitimate businesses? And why do people call
Yeah.
us a scam? And why does everyone want to put us out of business?
Yeah.
It's stuff like this. I mean,
Yeah, exactly. This is the stuff that gets the press. I mean,
that's right.
listen, all it takes is one of these clowns to do this, and they're on CNN, they're on Fox, they're on MSNBC, and then what is the knee jerk reaction that everybody's going to have? Oh, this whole industry is a scam. I gotta stay away from this. So
That's
yeah,
right.
you know what? I always say this to people like, okay, I'm in the credit repair space, not a credit repair company or providing a credit repair service, but it's certainly the industry that I'm in. And when I have conversations with other people in this space, I'm like, listen, nobody here can begrudge the fact that this is the reputation this industry has, because so many of our partners, friends, whatever you want to call them, cohorts in this space, we've done it to ourselves.
Yeah.
So it's an industry that has a reputation that it's very much given itself. John, I got to
Yeah.
tell you a quick. I got to tell you this quick story.
I agree. I completely agree. And, but another one bites the dust, right? So,
Yeah,
yeah.
yeah. So, oh, Mike, already with the question. Awesome. Here we go. So here's that question again. Can I trust Credit Karma scores? Equifax 805, TransUnion 790. I've been told to subtract 20 points. Any truth to that? I remember that. I remember somebody telling me that early on, John. Yeah, whatever you see on Credit Karma, you got to just subtract X amount of points, and that's going to be your FICO score.
Yeah, I mean, that may be the experience of a person. That might be their experience. I can tell you that my Vantage score credit scores are consistently lower than my FICO credit scores, and
Yeah.
have been for many, many years across many generations of those scores. And so I've had similar experience, but that's certainly that helps to support a theory, but that certainly doesn't prove that there's any correlation between the two. I can tell you that I know enough about kind of the behind the scenes inner workings of those scoring systems to know that they have no interconnectivity between the two, where one is always kind of dragging another one along 20 feet behind it.
Yeah, it's not like you're going to have like a dollar euro,
Yeah.
a translation
That's right.
or currency, exchange or whatever.
Look, there's enough places to get FICO scores and enough places to get Vantage score credit scores that this doesn't have to be a theory or a mystery. You could just check your own for free.
Yeah.
You can sign up for a variety of websites, and I'm sure if you have any number of certain credit cards, you're getting these scores on a monthly basis, and it's not hard to track them for yourself. But yeah, that's been my experience as well. Is that it's not frustrating, but it is what it is. They're still really good, but that doesn't mean that they're. And you wouldn't expect them to be the same. You would expect them to be what's called directionally similar, meaning that the scores should tell the same story if they're built well. And the story should be either low credit risk, modest credit risk, elevated credit risk, don't lend to this person or you're an idiot level credit risk. So so if you're a 800 and a 790, those scores tell the same story. If you're a 580 and a 550, those scores tell the same story as well.
Yeah. You're not going to see 150 point differences between FICO and Vantage score. At least I've never seen that kind of a spread between the two scores.
You shouldn't. I mean, the only time you'd see, because that transcends stories, right?
Yeah, that's right.
The difference between a 750 and a 550 or 6, that's a drastically different story. They're not telling the same story any longer. So the only time you'd see kind of radical differences in credit scores is if, one was based on a credit report that was clean and the other was based off of a credit report that had some negative information that was probably recent and severe. And that's why you would get pretty drastic differences in scores. And it's an interesting question pops up there that I don't know that we've ever gotten this question in any of these live events that we do, the webinars. But one of the questions that I get a lot is, well, can I use the information on one of my credit reports or the credit scores based on one of my credit reports as dispute documentation to the other credit bureaus? Meaning that if let's say hypothetically my TransUnion credit report is clean, but my Equifax credit report has, a collection, or my Experian credit report has a defaulted credit card account, and so therefore you would expect the scores to be pretty different there, because the data is different. And then the question is, well, wait a minute, can't I just kind of parade my TransUnion credit report around and show them this is what my credit report should look like? It shouldn't look like what your credit report indicates. And unfortunately, that isn't the basis for why the credit reporting agencies have to make changes to their data. The three credit bureaus, while they do cooperate in some respects, mostly when they're required to cooperate, they're still competitors, and they still don't do the same things. And there are some furnishers that report to one that may not report to the other two. And one bureau may have a policy with respect to deletions of items.
I was just going to start talking about that.
That the other two bureaus don't have. And so you wouldn't expect them to be all the same. In fact, when the bureaus all got together and announced earlier this year that they were going to be removing $0 medical collections in July, that was a joint press release. All the credit bureaus made that announcement, and you would have thought that the CFPB would have been really happy about that. Well, the exact opposite. They basically said, "Are these companies competitors, or are they a cartel?" Because they were essentially doing the same thing, and so it kind of underscores that they're really not supposed to be doing the same things in that respect. So no, you can't just parade your credit score around or your credit report around and expect the other bureaus to listen to it.
Yeah. So on that subject, John, was it? I did listen to that webinar, audio podcast, whatever you want to call it, with Francis, and Pepper Trout, that law firm. Now, correct me if I'm wrong. I thought that the decision was made unilaterally amongst the bureaus because it was either FICO or VantageScore or both that were able to determine that medical collections were not a substantial factor in credit risk, and that they didn't necessarily need them in their scoring model. Was that something that they discussed, or was that a bureau, something that the bureaus thought, even though bureaus don't obviously create credit scores?
Yeah, so it's a little bit of the chicken and the egg question. What came first? Did the scoring analysis come first and therefore allow the credit bureaus to do this, or did the credit bureaus say they're going to do it, and then the scoring companies just kind of came afterwards and did the analysis? And that's what ended up happening. The credit reporting agencies,
I see.
They don't ask for anyone's permission to do stuff like this, right? They announce that it's going to happen, and then all the analyses take place to determine what is going to be the impact of doing something like this on credit scores. And VantageScore came out with some data while I was on vacation that indicated that most credit scores really aren't going to move very much even after medical collections that have a zero balance are removed. And what that means is that they really have not much of an influence in the first place.
Well, are they basing that data on contemporary scoring models because they already don't factor the zero balance collections?
Yeah, that seems to make sense. I think they also took into consideration the delay. So this credit report would have had a collection, but this credit report under the new policies will not have a collection. Remember, they also removed they will start not accepting collections that have less than a $500 balance until after a year. So even collections that are unpaid are still on credit reports today, but they will eventually be gone if they are under $500. So there still are some scenarios whereby the collection would have been considered in the scoring model and therefore could have been influential.
Yeah. A couple of questions here from Mark. Actually, you know what, Marcus, I see you got two questions. I'm going to take the second one first because it's on topic. Are dental collections considered part of the medical bill arena?
Yeah. So if the collections don't contain any sort of coding that indicates what type of medical service it was. So if you look at a medical collection, unless you recognize the doctor, it doesn't distinguish between vision, dental, podiatry, you know,
Yeah.
whatever other type of. I mean, there's a billion different things you can go to a doctor for. So, but to the extent that it is coded, it's binary. It's either medical or something other than medical. And
Right.
so if it is coded as being medical, which obviously dental is medical, then the answer to your question would be yes. So
Yeah.
once it has a zero balance, it would fall under these new rules, and the credit bureaus would purge it.
Marcus. Oh, sorry. That was question number 2. Question number 1. What's your best advice for going from 712 to 800?
Yeah, it's a hard question to answer. I know
It's a
nothing
tough one. Yeah.
other than two scores. So those scores, even though they're only 88 points apart, are wildly different in credit scoring. It's not the same
For
as going
sure.
from, say, a 600 to a 700, which is
Yeah.
pretty easy. Um,
You're going
I
from running a 6-minute mile to a 4-minute mile.
That's right. That's exactly right. And any knucklehead can't do that. So think
Right.
of it as like twisting a rubber band. It's easy to do for a long time, and then getting those last 3 or 4 twists are really, really hard. So you're at the last 3 or 4 twists if you're trying to get to 800. That's really an elite credit score, and you have to max out on a lot of the metrics in order to get to 800. Because even though the published score range is 300 to 850, not all scoring systems can get to 850. In fact, if you
Yeah.
look at the scoring models that are used in the mortgage environment, they can't get to 850. They can get to like 830 or 833, depending. If you look at the score disclosure notices when you apply for a mortgage loan, you'll see what the range is, and it's not 850. And so an 800 is actually closer to a perfect score than you may think, because not all of FICO's scoring models will go to 850. I guess the best advice is, and I always tell people this, is follow the score factors. Anybody who sits here and tells you, oh, do this, do that, do this, without really looking at your credit reports and scores is just guessing. If you look
Yeah.
at the scores, they all come with score factors, which are essentially the top 4 reasons in order why the score wasn't higher. And so that's really your roadmap to a higher score, whether you're trying to go from a 712 to an 800, or an 800 to an 850, or a 500 to a 600. That way it takes the guessing, the guesswork out of score improvement.
Well, while you've been talking, I posted 2 things in the chat here. I'll put this up on the screen, but you'll be able to see it in the feed. So this first is, John, this is your blog post that's on at creditversio.com, the anatomy of an 800 credit score. Again, just some general good advice, Marcus, for how do you get an 800? What is an anatomy of an 800 credit score? And then Johnny did a great video on how do I get to an 850 score. So I was reminded of that when you talked about, hey, there's a lot of boxes you got to check. There's a lot of things you got to do right. There's things that you absolutely can't have on your credit report, like anything derogatory at all, to get into that elite level. So, Marcus, if you want to look down into the chat, you'll see that I left those articles for you if you want to go and read those a little bit later on your own time. Okay.
And another thing to keep in mind, this is actually back to Marcus's question about going to an 800. Keep in mind that you may not need an 800. If you look at the best published interest rates, so the lowest published interest rates by FICO score for auto loans and mortgages, you don't need anything close to an 800. So for auto loans, the best published interest rates are people who have scores of 720 and above. The best published interest rates, that's for auto. For mortgage, the best published interest rates are 760 and above. You really, I kind of think the question that you're asking is, how do you go from 712 to 760 is really what your question is, because in that scenario, you're getting into the kind of the safe zone with respect to both auto and mortgage lending. Obviously, to the extent that they're just looking at your credit reports and credit scores, obviously they consider other things like income and the loan to value ratios of the loan, so which has nothing to do with credit scoring. But you don't necessarily need an 800, and you certainly don't need an 850. And I probably pointed that out in that anatomy of an 850.
For sure, yeah.
You're going to drive yourself crazy trying to get 850 because you need basically every possible point. It's like a 300 in bowling. A 299 is not a 300. You didn't get every pin. So and you know, a 299 is not perfect, and a bowling a 150 is also not perfect. So they have the two things in common. So I always tell people that, try to score as best as you possibly can, but also be realistic that don't go nuts trying to hit 850 because you don't really need it.
Yeah. Also, too, another thing, Marcus, like, I'm just making a judgment from the picture. I don't know how old the picture is, but one of the things that is something more along the lines of a practical fact when it comes to credit scoring and getting into the eights and 850, like John said, not necessarily a life's ambition, but it's hard to do that under the age of 35, 40, because you really have to have age. You have to have a lot of time demonstrating that you know how to manage credit correctly across several levels of several types of credit.
Yeah, that's the one that, there's a lot of things on our credit reports that we can control, right? We can pay our bills on time. That's easy. Just pay your damn bills on time. That's 1/3 of the points in your score. You can, I know that there's exceptions and people hate it when I say this, but you can choose to not get into debt, right? No one's holding a gun to your head and ordering you to use your credit cards. So you can choose to stay in reasonable amounts of debt. You can have debt and have a perfect score. You don't have to be debt free. You can have a lot of debt. You can have hundreds of thousands of dollars of installment loan debt and have perfect scores. So this whole, you got to have zero debt in order to get perfect score. That's not accurate. So the debt metrics are another roughly 30%. So now we're at roughly 2/3 of the points in your score are entirely in your control. Inquiries, you got to apply for credit if you want credit. So don't avoid applying for credit. But eventually these inquiries are going to not count any longer. They're going to fall off your credit reports. They may not count anyways because inquiries don't always count. But to the extent you want to avoid inquiries, that's another 10%. And then the last two categories, one is the kind of the mix of information. Once you have some installment loans and revolving, you're really checking that box. So now that just leaves you with one more category, and that category is the time, the age-related metrics. And there's only two of them: the average age of the accounts on your credit report and the age of the oldest account. And you can't control that stuff because unless you're my age, or I guess David's age next week, if you're a young dude, you're not going to have a 30-year-old credit report. It's just mathematically impossible. So that's where you run into issues of it's almost like losing weight. Wow, I lost 20 pounds really fast and now I've plateaued. I can't lose any more weight. It's the same thing with scores. You may be able to plateau your score until you get to the age-related metrics, which have nothing to do with your age, by the way. It's the age of your credit report.
Right.
And so if you can't earn all 15% of those points, all the points in that 15% category, you're not going to have an 850. It's just that simple. You may have an 800 or an 810, and you're still going to be golden. But that's the one category that you just don't have as much control over because there's a time and longevity aspect to it that doesn't exist with the other categories.
Yeah, like what you said, John, was I've witnessed this with thousands and thousands of clients over the decade that I've been doing this. It's really not all that hard for people to, once they get on the right path, to go from the low 6 to the low 7s, maybe even sometime, maybe the low 7s, mid 7s. But like for me, it took maybe a year to go from high 5s to maybe low 7s, mid 7s. But it took 2.5, 3 more years or more for me to even start touching the high 7s, low 8s. because those are like the championship rounds. You really have to do a lot of things right to get into that category. And even still today, 10 years with really, well, about 8 years now that I think about it, with really good credit, I still bounce around the high sevens, low. I think 805 is the highest I've ever seen my score, and I think that was my mortgage score when I applied for my my mortgage loan. Yeah, there you
Here's
go.
mine.
845.
Here's mine as of right now. Literally, I
Eight-
pulled it like while we were on the phone.
Yeah,
That's from my
845.
Amex. That's from my Amex card. Yeah. So
Yeah,
sorry, Mike, not 850. But do I care that it's not an 850? Not at all.
yeah. All right, question from Scotty Groff. How long will a zero balance collection stay on my credit report, a credit report?
Well, if it's medical, it's gone. So it's gone. There's a whole lot of it depends on to that one. If it's a non-medical related collection, then 7 years from the date of the default with the original creditor is how long it remains. But the contemporary credit scoring models will already exclude it because they don't consider collections that have no balance. So it depends on the type of collection, and it depends on, I know your question wasn't about credit scoring, it was about how long, but you should also be aware that there's a credit scoring benefit to having it at a zero balance because the contemporary scoring models don't count $0 collections.
So we're talking about.
I don't know. I was having this conversation with some folks on my Facebook page earlier this week, and the momentum is against paid collections of all types, and the momentum is against medical collections of any variety, paid or unpaid. I just think that eventually we will wake up in a world where collections that have no balance are not on credit. That the only collections that'll be on a credit report will be those that have a balance.
Yeah, it sounds like it's going that way.
Yeah.
Well, when you say, John, contemporary scoring models, we're talking about FICO 8, FICO 9, 10, 10T, Vantage Score 3 and 4, right?
Yep. The ones that everyone should be using, except the mortgage industry that doesn't.
Set mortgage. Got it.
Yeah.
Amonswell says, hello. Good to see you. Treya, I see your question. What we do on these is we don't really dive too deep into credit repair tactics, but I promise I see that's from Facebook. Once we're done with this live, I will swing back around and answer that for you. All right. But I never met David. I didn't go in debt. Okay, Mike. Okay. Let's see, as far as your age of accounts category.
Hey, let me throw this out. I'm curious. I'm curious what your answer to this is, David. I'm curious what all the people who are watching. Do you consider credit card debt do you consider a credit card balance that you pay in full every month? Do you consider that debt?
No, I consider that expense because I use credit cards like I would use cash. Like, in fact, I was just having this conversation. Travis, who runs customer service, has been on vacation for the last week. And so I've been answering the phones, and I had a great opportunity to talk to people for the first time in a while. And I just had this conversation yesterday with somebody who was sort of up and coming, trying to establish credit. And one of the things I explained to him is like, listen, I put everything on my Citi card, on my Citi Visa card, my Costco card. And I know when the end of my statement date is, and I just pay it off in full. Because everything that I would normally pay cash for, I would just put on the credit card anyway. And every quarter when they give me my cash back from using the card for everything, it's usually between $600 and $800. So for stuff I was going to buy anyway. But no, generally speaking, I don't look at it as debt because I don't revolve it. It's more transactional for me.
Yeah, I kind of look at it as a perpetual alternative to cash with a 1 or 2% discount on everything that I buy because
Exactly.
I'm getting some sort of reward back.
Exactly.
From the issuer. Yeah.
Yeah. Here's Gregory right here, right in line with what we're talking about.
Yeah.
Use it as cash. Scott, good to know. Trey up, good. I appreciate that. Mike, same here. Okay, great. So we've got transactors instead of revolvers on credit card. Oh, you know what? This actually. Oh, hold on. I missed. I missed a Crooked Donald. Are open and closed accounts treated the same as far as your age of account category, or are closed accounts not included? I love this question. We get this.
Yeah,
We get
it's a
this
very good
question a
question.
lot.
It leads to a lot of myths.
It does.
Reputable writers can't seem to get it right.
I'll put that back up there.
So the answer to the question is actually, let's dig into this a little bit. So there's there's three categories of information that are commonly referred to as account level or trade level information. One is collections, like legitimate third party collections that are reported by the debt collectors. Number
Yeah.
two is before liens and judgments were removed from credit reports, you have public records, so those line items, and then you have accounts, so like accounts that you have with your creditors. The age-related metrics in a credit scoring system do not consider public records, and they do not consider third-party collection accounts. In fact, I'm using that terminology because that's the proper terminology in Metro 2. A collection is not considered a trade line. A collection is an account, a collection account. A trade line, which is like your Amex card, your Wells Fargo mortgage, your Costco Visa, Citibank Visa, those are all what are called lines of trade. Those are referred to as trade lines. Trade lines are the only entries that are considered in the age-related metrics. And as long as those are on a credit report, doesn't matter whether they're open or closed, they are considered in the time and file related measurements. So where the myth tends to come is this whole issue of closing credit cards and why you shouldn't close credit cards. And I don't know where this myth started. It certainly didn't start by me giving a bad interview, but one of the common myths about the closing of credit cards is that you shouldn't close them because you're going to lose the value of the age of the card if you close it.
Right.
That's wrong. That is factually inaccurate. And I can't tell you how many times FICO has repeated that. We told people that when I was there. They've told people that ad nauseum, but for some reason people just refuse to believe it. If you have, in fact, closed accounts continue to age in credit scoring systems. And so if you have a 10-year-old American Express card, in a year from now, it's going to be an 11-year-old American Express card. And in 2 years, it's going to be a 12-year-old American Express card because it's all relative to the date opened field. And so the only way that you lose the value of the age of a trade line is if that trade line is removed from a credit report, meaning it's gone and it's not on the report any longer. And that happens. What happens sometimes is credit repair people kind of backfires on them because they may dispute something that's really, really old, but still like a credit card they opened 15 years ago that they fell on hard times and defaulted on it and was charged off 6.5 years ago. So they're still getting the benefit of the really old account. And the fact that the charged off aspect of it is so old that it's really not that big of a deal. And then boom, they argue about getting it deleted. It gets deleted and their scores go down instead of up.
I just had that conversation yesterday.
Yeah, okay. And the reason it went down is because you just removed A, maybe the oldest account on the file, and B, certainly one that was helping the average age to be older.
Yeah. Exactly what I told the guy yesterday is he had a charge off. The account was 9 years old. It charged off like 6 years ago. I'm like, listen, dude, this is going to drop off here. I wouldn't force it because when it does drop off in 9 months to a year, you're going to feel it because you've only got 2 or 3 other good lines of credit and they're all brand new.
Yeah. It's the difference. You know what it is? It's the difference between mindless scatterbomb credit repair versus someone who actually knows what the hell they're talking about.
Exactly.
Right. But because all these credit repair bot systems that are out there would automatically flag that for a dispute, just because it has something derogatory, some derogatory aspect to it, without really putting much thought into whether or not it's actually a good idea to try to argue. I have this conversation with my dad a lot. So my father, who still doesn't know what I do for a living, even though I'm 54 years old now, he thinks if you don't report to a manager that you don't really have a job.
Right.
Um,
Right. I
we
get
may
it.
have had we may have had this conversation. If you don't have like a badge, then you don't really have a job.
Yeah, my
Um,
dad has my dad's city worker, retired police officer, pretty much has the same perspective.
yeah. So his argument has always been, well, I pay my bills on time. I have perfect credit. I'm like, Dad, I'm sick of having this argument with you. That's like 1/3. The next time we get a pizza, I'm going to give you 1/3 of it, and I'm going to get 2/3 of it.
That's great.
I try to make it relative to his stomach, and perhaps he understands. But yeah,
Yeah,
that's again the difference between kind of mindless carpet bombing versus, it's a difference between being nuclear versus being strategic.
exactly. Yeah, I put Gregory's up because same thing. Like he was under the impression that you if you close a card that you're going to lose the trade line, and that is not the case at all. Okay, I think we got everybody's questions so far. Um, Excellent. Hey, Donald, glad you like it. Okay, so John, as I said a second ago, I spent some time this week and last week covering on the phones while my customer service manager was on a very well-deserved vacation. And one of the things that I am starting to see, I got this from a couple of phone calls, and then we're seeing this a little bit on credit reports. Remember when COVID started? One of the trends that we saw were credit card issuers closing credit lines that might have been stale or unused for a while, or reducing the dollar amount, the line of credit itself,
Right.
to safeguard themselves from obviously what was going on with the shutdown at the time. So, and we saw that a lot. I can't tell you how many phone calls we took in, like, hey, why did my score drop? And at first, we had to look at everything, like, oh wow, you have lines of credit that were closed, and you had a $10,000 credit limit here, and now it's a $5,000 limit, and you have a $3,000 balance on it. This is what's taking place. So it
Yep.
seems like that stuff is all leveled out, but now it looks to be happening again.
Okay.
Now, I know I didn't prep you for this question, so we can go in whatever direction that you want, but it's starting to, this is purely anecdotal. It's a handful of cases, but I'm wondering that with big banks, lenders, big credit card issuers looking over the horizon, thinking, yeah, we're probably, it's unavoidable at this point to slip into recession. I wonder if they're once again kind of hedging their bets and maybe reducing lines and closing inactive credit lines. What do you think about that?
So this issue of the influence of inflation. Well, first off, there's a really easy way to determine if inflation is, and I'm not talking about the price of gas. I'm not talking about you having to wait a half a year for a new car. I'm not talking about that. I'm talking about the actual inflation rate and the direction of the rate of inflation. All you have to do is go check the return for I bonds. If you don't know what an I bond is, it's a savings bond that's issued by the U.S. government, and you can buy I bonds, and you get a return over time, and that return is based on there's a model that the Treasury uses to determine the return that you're going to get for I bonds, and it's 2x the rate of inflation. And so don't listen to all the people yelling at you on television. Don't listen to the angry people on TikTok and Facebook and Twitter. Go to the treasurydirect.gov website and look up the charted trajectory of the rate of inflation. And that's not a political thing. It's just, this is what the rate of inflation is, and that's how they set the return for I bonds. And the rate that you're getting for I bonds when the market was rocking was like 0.5%. It was tiny because there was no inflation. The return now for I bonds is 11%.
Wow.
Yep. And so, and I'm not excited about that, but I have a ton of I bonds that I've been buying for decades,
Mm.
and nothing else that I own is getting 11% right now. And
No,
so
that's unheard of.
it's actually almost it's almost converse what the market's doing. So go look. Don't listen to John. Don't listen to David. Don't listen to the TV. Look at the Treasury's website and look at the rate for I bonds. And it's you can see when it started and you can see the trajectory of inflation. I'm not the only one who knows how to do that, right? All the big
Mhm.
banks and all the big credit card issuers employ economists, right? They all employ because they all have wealth management groups, and their wealth management groups invest wealthy people's money. And one of the things they do is they do research on the economy and find out where do we put their money to make it safe and make it grow. So they all employ economists, and so these economists, I can't say they know, but they think they know the market and what the world is going to look like in the next 6, 12, 24, 36 months.
Yeah.
And yes, they will advise the risk people on the lending side of the house as to what they believe is going to happen. And so the risk side of the house, there's a reason they're called risk managers, right? There's a difference between the risk manager and the marketing manager. The marketing manager wants more, more, more. The risk
Yeah.
manager wants less, less, less. And so
Right.
that's when you start seeing stuff like an increase in the minimum credit score requirements for certain loan or credit card products, and a willingness to alter the existing terms of accounts that are not profitable. And an inactive credit card is not only not profitable, but credit card issuers lose money on inactive credit card accounts that don't have a balance. They don't make it. It's not that they're breaking even and making nothing. They actually lose money every month on those accounts. And so that's right. So Greg
explain
just
that?
looked it up. It's over 9.6%, is 2x the inflation rate. And so again, he didn't go to the DNC or the RNC or anybody's Twitter feed to find that. He found that off the U.S. Treasury's website. So, but yeah, that's what ends up happening, David, is people should consider it a leading indicator of what banks think the economy is going to look like in the next couple of years.
Yeah. Hey, real quick, how are we looking on time? Okay, we got a few more minutes. Explain how, if you can dive in a little deeper, how do credit card companies lose money? Did you say lose money or just not making any money if they have?
Lose money. If
So
you
how are
have
they?
a credit card,
Yeah, how are they losing money? Let's just say they got one example. They got somebody with a $10,000 line of credit that's not being used. Is that what you're referring to? Just lines of credit not being used? Okay, great.
Yeah. If you have a credit card with whatever the limit is, and it's got a zero balance, you're not using, meaning that you're not paying a balance every month. You're not paying interest every month on a balance. There is no balance, and you're not using the card. You're not transacting. The card is inactive and it's collecting dust in your wallet. The credit card issuer is losing money on that card every single day. Losing, not just breaking even. They're losing. So number one, you'll agree with me that a $10,000 limit that's not being used as an opportunity cost loss for someone else that they could give that $10,000 line to who may use it. So that's number one, is there is an opportunity. But that's not really even what I'm talking about. That's number one. Number two, you'll agree with me that whatever account, they're called core systems, whatever account management core system that the bank is using, that my account resides in it and all my information is in it, you'll agree with me that there's a cost involved with the space in those core systems. So the fact that I'm even in their system is a cost to them. That's number two. But that's not really even what I'm talking about either. Number three, you'll agree with me that there's a risk to the bank if I go out today and lose my job and I say I'm going to take out a cash advance against my credit card because I know I'm not going to be able to pay it back, but I need that money to survive. There's a cost associated with the risk of that happening, but that's really not even what I'm talking about either. Here's what I'm talking about: the actual hard cost. So number one, there is a cost associated with creating that card and sending it to you. There is a cost of materials. There is a cost to mail it to you. There is a cost involved with doing that. there was a cost involved with buying the credit report when they opened your account. That wasn't free. There was a cost involved every single month when they buy a new credit report and credit score for their account management process.
Mm.
And
Okay,
so there's a
didn't think of
cost,
that.
whether it's a dime, a penny, a dollar, it doesn't matter. It's a cost. And the fact that you're not using your account means that they're not able to charge you fees, interest, or the swipe fee to a merchant for accepting your card. And so there's all these, there are either hard costs or soft costs associated with a open but inactive credit card account. And which is why before the Card Act, credit card issuers were starting to charge inactivity fees, because that was their way. The consumer advocates looked at that and said, "Oh my God, this is so unfair." But if you listen to the bank explaining, well, hold on, there's a cost involved with all we're losing money on all these people. We can either close their accounts,
Right.
and go do business somewhere else, or we can just charge them a nominal, $79 a year, $29 a year. But people went crazy when they saw that. So now it's illegal to charge inactivity fees. And so now you see stuff like account closures and the reductions in credit limits, which piss people off too. But that's in lieu of getting hit with a $29 fee or some other fee associated with inactivity.
Scotty Goff asked a good question. What if they charge an annual fee and it's not being used? Are they still losing money? It almost sounds like that annual fee might have, I don't know, I guess you could maybe bake in that inactivity loss.
It certainly depends on the annual fee. I mean, if you're looking at, some of the high level Amex cards where your annual fee is $500 and $600, obviously that's how Amex makes a lot of their money, is annual fees, right? For their charge cards. If you're looking at some cards have an annual fee of like $79, it's really not that much. So for those, that's almost an incentive to either use it or lose it, right? Because that annual fee is just enough that you're like, man, they hit me for $79. I'm not even using this card. Maybe I should just close it. And then you read articles from me, and we're talking about how you should never ever do that because that's a bad idea. And it's almost like an incentive to get out there and use it so that you get the value out of the $79. Because look, if it's a $10,000 credit limit, and that's not even a good credit limit on a credit card, 15, 20, 30. I have some cards that limits are almost 40,000, and I don't pay an annual fee at all. But I would gladly pay an annual fee to maintain a really large line of credit like that for a variety of reasons: credit score, insurance. I like the capacity to be able to use it if need be, and I like keeping my powder dry because maybe tomorrow I will want to start using that card.
Yeah, exactly. All right, where are we? Yeah, we're coming up on 50 minutes. John, great stuff. This day flew by, or this live flew. Great questions from everybody too. We had a lot of questions.
And thank you, Greg, for what's the word I'm looking for calling my bluff. Because I could have just been saying all that and bullshitting and making all that crap up about the U.S. Treasury. And thank you.
Yeah, he did a little fact checking.
Thank you. And I don't know Greg, and I don't know if his last name is actually Sagacious, but he validated what I said. And I wish people would do that before they just start going screaming around and getting angry at everybody. Is verify what you're being told, and Greg did it. So bravo to Greg. He's the viewer of the day.
Absolutely. If we're going to give you some kind of a virtual trophy, Greg. But at the moment, it's just our appreciation. Just to continue on that subject, John. What's so funny is that I don't think there's really much of anything that you and I talk about in these videos that people can't Google and verify. I mean, a lot of this stuff is on FICO.com. It's on Experience, on Equifax. I mean, if you did a little bit of reading and get past all the clowns on YouTube who, like you like to say, stand in front of homes they don't own and cars that they don't own and come up with all these wild theories. Well, why don't you go fact check? If you want to know something about FICO, go to FICO, for God's sakes. It's not like it's a black box. I mean, there's a lot of great info. Actually, I have an Experian app. I love my Experian app. I've had it for probably 8-9 years now. Man, they've got really good credit information on my Experian app. Great articles. They have a handful of videos. I mean, it's really, really good stuff. Credit Karma's got some good stuff too.
Yep.
I don't know what they're looking like now that they've been bought by Intuit, but a couple years back, it was a great source for credit education, real stuff. Not this crazy stuff we're seeing everywhere. We're not the stuff that probably this person put out to get their customers.
Ah, boy, that's bad stuff.
Bad stuff. All right. Great live today, John. Thank you very much. I appreciate it. Wonderful information. Everybody that was watching today, thank you so much for your questions and your participation. We're going to call it a day, and we will get together again Wednesday, 6 p.m. Eastern Time. Until then, thank you very much. Have a great rest of your week. Take care.
Thanks, y'all.